Hi, good afternoon. I'm Rennie McConaughey with Aberdeen Standard Investments. Well, there's a number of things one looks at, and it's quite interesting because there are different rates of growth in different countries. The developed markets are growing a little less strongly. The emerging markets are growing more strongly. So one looks at a number of things, where we are in the economic cycle, the demographics of the economy, productivity opportunities within the economies, and by definition, most of the developed markets are scoring lower marks in terms of productivity and demographics and so on and so forth, whereas in the emerging world, those dynamics are much more strong. We're seeing a recovery certainly in European growth. A number of the major European economies are posting quite strong GDP growth now relative to where it was. In the US, I think forecasts have nudged up. I think a lot depends on the ability of the President and Congress to put through tax reform and infrastructure spend. Those are the big swing factors there. But the most consistent growth is still going to come from the emerging world. China may be slowing down, but it'll still grow at about 6.5% per annum. India, another of our favourite markets, is growing at about 6.5% at the moment. We expect that to rise. So whilst as ever there's a whole range of different forecasts for different countries, the major theme is for continued strong economic growth in the emerging world and less strong growth in the developed world, albeit moving in a more positive direction than it's been. Well, you can play emerging markets one of two ways, either on a regional basis, where you have funds that invest that way, or there are single market funds as well. Now, I think a lot depends on your risk tolerance. Obviously, a regional fund is more diversified, and therefore your risk is more diversified. Equally, there are a number of countries, and I'm thinking of countries like India or Indonesia at the moment, where there is significant reform taking place. You're seeing continued move upwards in terms of economic growth forecasts. Inflation forecasts are coming down, rates are coming down, and the reforms that are taking place are really strengthening the governance within both countries and the financial institutions within both countries as well. So whilst you are betting purely and simply on that one country by investing in a single country fund, you can get real exposure to that, which you don't perhaps get in a more diversified fund. But you need to understand the risks you're taking on board when you do that. And whilst I'd never tell investors that they shouldn't invest passively or shouldn't invest in mutual funds, it must all be in closed-end funds, that's nonsense. There are homes for each investment vehicle in every portfolio. But I think the advantages of operating with an active manager are such that you can sense the opportunities if you have boots on the ground in those countries and have fund managers based there, which we do. There are any number of stocks and bonds that don't appear in indices. So therefore, if you go in with an ETF or an index provider, you miss out on significant investment opportunities. The Indian bond market, for example, is in virtually no index at all, yet it's been a very successful market to have been invested in. So you get a lot more variety by going with an active manager, and there are risks in emerging markets just as there are in any other market. But if you're investing through a manager that knows the companies well, knows the bonds well, does deep due diligence on every investment they make, you can hopefully avoid a lot of the pitfalls that you get by either investing with an inexperienced manager or investing through an ETF where you get the good companies and the bad.